So we are now going to talk about adjusting entries, which are accruals. The last thing that we talked about were deferrals. So now we're going to talk about accruals, and some of the things that are here will look familiar because you did them before and you didn't even realize they could be a form of an adjusting entry. So we are still at this point right here, the 1, 2, 3, 4, 5th place where we are journalizing and posting the adjusting entries. So accruals are done for either revenues for services that we performed for a customer that we haven't billed them for yet, and we haven't put them in our books yet, and they haven't paid us yet, or expenses that we have incurred, which means they've happened, expenses that have happened, but we haven't paid them yet or recorded them in our books. So examples of that might be if you get a PG&E bill in the mail, right? You're not going to pay it right that second. So you have to put it into your books. So what you would do to put it into your books is you would debit utilities expense, and then you would credit something like utilities payable, right? Or accounts payable. So that would be like for the expenses. Now for the revenues, usually all revenues are recorded when it actually happens. You know, when you make a sale to the customer, like for instance, when you go into like McDonald's and you buy something, or you go to Home Depot and you buy something, they are posting that sale into their accounting as soon as you get it. As soon as you get the item, they've posted that into their sale. And at the end of the day, they push a button and their computerized system adds up all their sales for the day. So it puts it in the revenue and all those good things. Now, a lot of people say, well, if everything's computerized, why do we have to know accounting? Because somebody has to set up those systems. And if something is done incorrectly, you have to understand accounting in order to know how to fix it. So, and then there are still manual entries that have to happen. So an example of a manual entry that would involve revenues, that would be an adjusting entry, would be something like, for instance, let's say that we, let's just say the power went down at Lowe's, right? And you went in there to buy some seeds to plant your garden at Lowe's. Now, if their computer system was up, they would put it in their computer in the register, right? And it would automatically register it. But if the power was out and they went ahead and did a cash sale, well, when the power came back on, that sale would not be in their system, right? It wouldn't be in their system. So they would have to do an adjusting entry to get it into their system. So they would debit cash because you paid cash, and they would credit sales revenue because they sold you the product. Now, when we're in the real world, we don't see that happen that often. But where this might happen with companies is that if you've ever seen like a street fair where they have like vendors that are selling things like, I don't know, olive oil or things like that, or you see an art and wine festival where they're selling that kind of stuff, or there's people that are like making candles or jewelry or things like that, right? Or maybe if you go to a trade show, when you get into your careers, you may go to a trade show. And so like, for instance, I go to a trade show every year for online teaching and learning. And when you go there are vendors there that are selling things. So they might be selling, like it's something like that, they would be selling like books about online teaching, right? So for those people that are selling the books there, they're not putting it into their computerized system right there. So when they go back to their company, then somebody will do an adjusting entry to enter those sales into their computer. So that would be, and maybe we have an account with the company, maybe it's like McGraw-Hill, or maybe it's Wiley Plus or something. So what they would do then is they would debit accounts receivable because I'm going to pay them later, and then they would credit sales revenue, and that would be the adjusting entry. So that's something you've already been doing when the sales occur, but it could be also done later with adjusting entries. Not done very often. For most companies, that's not done very often. Okay. So with the accrued revenues, we are what they call they're accruing the revenues. So in other words, they're posting the revenues, they're recording the revenues before they actually get the cash. And this is the one that you've done already. Now, the ones that you might see that might be new account titles, but it's the same thing, is we might have interest. We have service revenue, we've already seen that, and we might have rent. So we might have rent revenue. So there may be some revenues that are maybe a little bit different titles, but they'll still be a revenue. And the way you would know is if you looked in the accounts for the problem, it would list the accounts. And if it listed a different kind of revenue, like rent revenue, and the problem was talking about rent, then you're going to use the rent revenue. But it could be where it's just going to be service revenue. So if they didn't list anything but service revenue, then you would use the service revenue account. Most everything's going to be service revenue. Okay, so you're definitely going to want to know this and make a note of this, that the adjusting entry for accrued revenues, you're going to debit an asset account and you are going to credit a revenue account. So that's going to be your adjusting entry. Debit an asset account to increase it and credit a revenue account. And generally, the most often it's going to be accounts receivable is going to be your asset account, and your revenue account is going to be service revenue. That's generally what you're going to see. Okay. So we're going to look at an example here. In October, Sierra Corporation performed services worth $200 that were not billed to clients on or before October 31st. So on October 31st, what they're going to do is they're going to debit accounts receivable. That's the asset account because they're going to receive that money later. And they're going to credit service revenue because they have earned that revenue. They have provided that service. Then it says on November 10th, Sierra receives cash of $200 for the services performed. So this means the customer paid for their items or paid for their service. So when you're paid cash, what are you getting? You're getting cash, right? And anytime it says pays or paid, we know the cash account is involved. And since we're getting paid cash, our cash is going up. So we are going to debit cash $200. And then we're going to credit accounts receivable $200 because the customer is paying us. So this will clear their account out and show that they don't owe us any money anymore. Okay. All right. So we can see these type of entries for interest, rent, and services. Then when we get into the next chapter, we're going to get into sales revenue. But right now, these are the only ones that we might see. Don't worry about the reason for the adjustment. Don't worry about the accounts before or after the adjustment. I think those just confuse people at this point. If you want to read them, fine. That's fine. But I would say don't really focus on those. Now, the thing you do want to focus on is that your adjusting entries are going to be debiting an asset and crediting a revenue. That's going to be a key piece for those. Okay. So let me go to the next slide here. Okay, accrued expenses. So these are expenses that you record in your books before you actually pay it. So a big example of that is salaries, right? So every day, if you have a job and you work 5 days a week, every day that you go to work, they don't pay you at the end of the day, right? So sometimes you don't get paid for 2 weeks. If you work in the community college system, like I do, I get paid once a month. So that means that they do adjusting entries in order to enter in the amount that they owe to their employees at the end of the month if they haven't paid them yet, okay? Rent could be accrued expenses, interest, and taxes. So we'll look at some examples of that. So when we have accrued expenses, adjusting entries, we are going to be debiting a liability, debiting an expense account. So that might be something like salaries and wages payable, utilities payable, accounts payable, something like that. Excuse me, I don't know what is wrong with me today. You would be debiting an expense account, such as salaries and wages expense, utilities expense, a rent expense, something like that. Forgive me for that. Those are all expense accounts, right? And then you would be crediting a liability account, such as salaries and wages payable, or utilities payable, or accounts payable, or something like that. Okay, so those would be the entry for these type of adjusting entries that you will want to note. Now, here's a example of it, and this is going to take us back to that little formula that I showed you earlier about using the fraction. But this formula here, you're going to want to write it down, and this is one that we are going to have a whole chapter looking at liabilities, and you're going to be using this chapter a ton. So let's go over the problem first. So Sierra Corporation signed a 3-month note payable in the amount of $5,000 on October 1st. The note requires Sierra to pay interest at an annual rate of 12%. So what that would mean is that every month you would have to do an adjusting entry to post the amount of interest that's due for that loan. And what they call this formula is either face value times rate times time, or principal times rate times time. Okay, so P times R times T, principal times rate times time. So the way it works is that the principal or the face value is the face value of the note, $5,000. The rate is the annual percentage rate. So this means this is for an entire year, So because this is for an entire year, when you come over to the time, you're going to have a fraction, and the bottom part is the numerator or the denominator, the bottom part is going to be 12 for the number of months in a year, 12 months, okay? The top part, the 1, is going to be the something. Remember when we looked at the other problem, the something, and the something is either the date that you last did the interest to the date you're doing the interest now, but if the interest has never been done, then it's going to be from the origination date of the loan to the date that you're doing the interest. So in this case, we're doing the entry on October 31. If we look up above, the loan originated in October 1. So that means that the interest has never been done on it. So that would be one month, all of October. So it would be 1/12. And down below here, you'll see where I showed you that 1/12 becomes the decimal of 0.0833333333, right? So it would be $5,000 times 12% times 0.083333, and that would give you $50. So the interest would be $50 for 1 month. Okay. And then what you would do for the entry is you're going to debit an expense and credit a liability, right? So you're going to debit interest expense, $50, and you're going to credit interest payable, $50. Okay. So we're going to do some more of these, but this is, as I said, this chapter is all new information in a lot of ways. A couple of things will look familiar, but a lot of it's going to be brand new. So that's kind of a brand new thing. So hang on to that because we're going to do sample problems for all of these. Okay, now let's look at this one that has to do with salaries. So Sierra Corporation last paid salaries on October 26th. Okay, so that's right here, right? October 26th. Okay. The next payment of salaries will not occur until November 9th. So that's way over here, November 9th. Okay. The employees received total salaries of $2,000 for a 5-day work week, or $400 per day. Thus, accrued salaries at October 31 are $1,200, $400 times 3 days. So in other words, what happens at the end of October, you have to say, how much do I owe my employees in salaries for the month of October that I haven't posted yet? And you would have to do an adjusting entry to get that in your book. So you would be posting for October 29th, October 30th, and October 31. So that would be a total of $1,200, 3 days times $1,200. Now, I'm going to tell you, you're not going to get a problem like this on the exam for the salaries and wages, but this is something that you need to kind of be familiar with, all right? Okay, so here's what the entry would be. The entry would be, you would debit salaries and wage expense because it is an expense for the month of October. Your people worked and you owe them that money, okay? And then you would credit salaries and wages payable, okay? Hold on, let me sneeze. Okay, all right. So the next one is just the recap. Again, don't worry about the reasons for adjustments or the accounts before and after. What you want to know is that the expenses could be interest, rent, salaries. The other one is utilities, might be another one. Another one might be repair and maintenance expense. This is another possible one. And for the adjusted entry, you're going to debit expenses and you're going to credit liabilities.